The gold market is on an unprecedented tear. The metal's price is rising at a historic pace, especially in the last few days and weeks. At the start of the year, gold was hovering around $2,620 an ounce. Back then, the average bank forecast was that by the end of 2025, the price would only go up by about $175, topping out at $2,795 after 12 months. But today, in October, the price is closing in on $4,350 an ounce. Gold has surged over 50% in less than a year. That's a rally we haven't seen in 46 years. Gold is now at its all-time high, and what's baffling is that the indicators supporting its continued rise far outweigh the indicators pointing to a pullback or a correction. There are so many factors in the market right now driving this accelerating global rush into gold, and it's not just central banks anymore. So, the question is, what exactly is going on in this market? And why are prices exploding this fast and by this much? And the most important question of all, how high can gold actually go? I mean, a year from now, where can we expect the price to be? That's just part of what we're breaking down in today's episode. I'm Abdullah Muayyad, and this is the Economic Insider Plus. Back in July 2025, President Donald Trump blasted Fed Chair Jerome Powell, calling him a numbskull, or an idiot, because he refused to cut U.S. interest rates like Trump wanted. This statement was one of many attempts by Trump to pressure the Fed into cutting rates. But the Fed, led by Powell, defied that pressure and stood firm on its position, that the central bank's policies are independent of any political influence and are driven only by economic data. Trump, simply put, wants the Fed to open the floodgates and adopt an expansionary monetary policy to counteract the effects of the trade war he's waging on China and other countries. But Powell clearly opposes this, holding firm to the bank's independence and ignoring Trump's wishes, which provoked the president, and even led him to threaten to fire Powell. Sure enough, just days after Trump's attack, the Fed confirmed its stance. The FOMC decided to hold interest rates steady in the range of 4.25% to 4.5%. One of the members who voted for holding rates and not cutting them was Lisa Cook, a governor on the Federal Reserve Board. On August 25th, Trump sent Cook a letter informing her that he was firing her from the Fed, claiming she had committed mortgage fraud. This move rocked the market. Why? Because this was the first time Trump had tried to fire a sitting Fed governor. If he succeeded, it would open the door for him to fire more Fed members and replace them with loyalists. And if that happened, the Fed's independence would be dead on arrival. Cook's firing immediately turned into a legal battle. The Fed governor filed a lawsuit in Washington, asking the court for a preliminary injunction to block the firing. She argued that the Federal Reserve Act only allows a governor to be removed for cause. The court actually ruled in her favor. And when the Trump administration went to the Supreme Court asking for an emergency order to remove Cook, the Supreme Court refused. But even though Trump failed to fire Cook, his constant, aggressive attacks on the Fed, including threatening to fire Powell himself multiple times, has terrified investors that the central bank's independence is in serious danger. From an investor's point of view, if the Fed loses its independence and becomes politicized, it'll be far more likely to cut interest rates just to please Trump. And if that happens, it could cause inflation to spike and crash the value. In this climate of fear and anxiety, fueled by doubts about the Fed's ability to withstand these constant attacks, investors fled to the most famous safe haven of all time in crises like this: gold. According to data from the World Gold Council, in the 4 weeks ending on October 5, 2025, net inflows into gold-backed ETFs hit $13.6 billion. That brings the total net inflows into these funds just this year to over $60 billion. According to Goldman Sachs, These ETFs bought over 100 metric tons of gold in September alone. The amount of gold these funds now hold exceeds 3,800 tons. That's a massive number, rivaling the holdings we saw during the COVID-19 crisis, when the entire market was panicking and hiding in gold. Gold funds have benefited massively from this shift in investor sentiment and strategy in recent months. I mean, everyone knows the traditional wisdom in the markets, especially in the US, is the 60-40 portfolio. 60% stocks, 40% bonds or fixed income. But recently, more and more voices are saying, guys, gold has to be a core part of your portfolio, given the state of instability that's only gotten worse. Last September, Mike Wilson, the CIO at Morgan Stanley, advised investors to change their portfolio split to 60-20-20. That's 60% stocks, 20% bonds, and 20% gold. This portfolio split makes an investor's hedge against inflation far more effective and flexible. If even a small fraction of investors follow this advice, trillions would be redirected into the gold market. This intense demand, driven by fear or FOMO, has caused gold prices to spike. For example, in September alone, the price jumped 12%, the largest single-month increase since 2011. Central banks also kept buying. For each of the last 3 years ending in 2024, central banks bought over 1,000 tons annually. The ECB reported gold as the second largest reserve asset in 2024. So, central banks are buying, and investors are buying. Gold is up over 50% year to date. A perfect storm of events cranked up uncertainty and sent the market into a frenzy. According to Goldman Sachs, if just 1% of privately held U.S. treasuries move into gold, the price could surge past $5,000 an ounce. That's the scenario markets are worried about. If you had $10,000 right now, would you start a business with it, or would you buy gold? I'll be reading your answers in the comments. If you like this episode and want more, subscribe to the channel. Peace.